Elliott analysis, well known by most technicians, is also a technique that fascinates a lot of traders, and one thing that particularly fascinated me, or a series of others. There are several points that fascinated me and still fascinates me every time I approach the Elliott theory. Is and even if I don't use Elliott wave on a daily basis, the same as with the Dow theory, something that I like to come back from time to time and pick those key elements from these old theories. And the Elliott wave theory is constructed around a few rules. In fact, Elliott wave may seem complicated at the beginning because the variety of combinations of different patterns that exist, but in fact it lays down to a few rules, a few hard rules, but quite many guidelines. And these guidelines, some of them are really of interest to use with any other type of technical approach or strategy that not necessarily involves the Elliott waves. One of the things that Elliott found is that the sequence, that this wave sequence of five advancing waves and three correcting waves, that this sequence is constant across all time frames. This is something that happens in larger time frames, in lower time frames, and for him, the time in terms of time duration, that the time that is needed for a certain wave to form, is less important than the shape of the pattern. So time is less important than form. Not time in the sense as we will see later on with GAN, which takes a different dimension, but here is the importance of the form in itself. So Ralph Nelson Elliott was discovering that there were some patterns inherent to the market structure, forms that were also seen in other complex systems, in social behavior and so on. So it seemed to be that the universe was built upon certain forms that he condensed in his theory. And the interesting thing is that although we have a combination of impulsive, so-called impulsive waves and corrective waves, the key point, or the most profitable moments in the market are those that he called actionary movements. And actionary movements are those that put you in profit early and fast, and so allowing you to protect your profits, or even protect your risk, and be out of the market in a short time, because remaining with an open position in the market is always an added risk that you have. So actionary movements, be of impulsive or corrective nature, are the ones that are most profitable. But the fact that market spends more time in corrective mode than in impulsive mode, or making corrective overlapping movements, is something that by observation we can absolutely agree that the market spends much more time correcting or ranging or bracketing than than displaying fast and impulsive moves. So, but the very fact that the market displays this the fractal structure allows us also to find these actionary movements within corrections that may seem complicated from a certain time frame, but on another time frame, on a lower time frame, for example, a ranging market may display very profitable trends, so to say, very profitable actionary moves, and this is one of the key points to the modern money manager, so to say, this diversification by time frame. This is something that, especially in times of bull markets, was something that was not very followed by money managers, and we have the modern portfolio theory that talked a lot about diversification, but there was not this specific type of diversification, which is diversification by time horizons. There is always, in the auction process of the market, there is always one time frame, one time horizon that is leading the market at that point. And in that sense, the Elliott waves can help you in finding that sweet spot, so to say, and profit from there. Talking about sweet spot is also worth saying that followers of Elliott wave analysis usually do not spend time labeling all the time frames and all the markets completely with wave counts, but they have the particular pattern that they follow, and they capitalize on it. So it's not as complicated as it might seem for those that don't have experience in Elliott wave. It's about learning the few rules and being familiar with the guidelines, and with a little bit of experience, finding that particular pattern that may be more appealing to you, and find that pattern across different time frames. And Elliott wave analysis allows you to do a top-down or a down-top approach in both directions. It's one of the flexibilities that it offers, is that it's the form really what matters, and not the time or time frame. And when we talk about Elliott, obviously we have to cross Fibonacci, and although Fibonacci, or Leonardo di Pisa, as he is known, was not a chartist or a market technician. In fact, we have to go back to the 13th century to find his works. He was a very well-known mathematician of his time, and his influence are not fully recognized even nowadays, and not only for the technical analysts, but if it wouldn't be for the works of Fibonacci, we wouldn't have a technical analysis at all. And this is not it's not because the series, the Fibonacci sequence, wouldn't exist, but the very fact that he was the one that brought the Indo-Arabic numbers to Europe, without which we couldn't imagine technical analysis. I can't imagine following charts with the Roman numbers right now.